Hi, welcome to the Smart Money Show. My name is Frank Corbin, your host. Today we have an interesting topic to discuss. We're going to talk about how you can protect your assets, your hard work, your wealth, using a dynamic strategy that I call insurance. More important, life insurance. Today I have with me a financial advisor from Sun Life Financial, Russell Fraser. Welcome to the show.
Thank you for having me.
Thank you for coming out. Now, here's the thing. People talk all the time about life insurance. Everywhere you go, from the online to inside the banks to, they're pushing life insurance, life insurance, life insurance. And my first question to you is, how much life insurance do we actually need?
Well, usually what happens is when I sit down with somebody, that's the number one question that they always have. But what I do is I go through all the assets and all the liabilities, and we're able to make a decision from there if it's the right amount, for you, and then I give you the options of different products that we can use to cover the liability.
Right. So is there like a magical number or some form of formula we can say, well, I hear some company says you need 5 times your income, some say you need 10 times your income. What's that magic number really?
Usually, we look at about 8 to 12 times your income. But I mean, it is important to sit down with a licensed advisor like myself, and we could, look at every angle there and make a good decision on how much
insurance a person actually needs. So when you sit down and you assess a person's financial situation and you see, well, 8 to 12 times the income is not really cutting it. Maybe the person needs a lot more. What do you do at that particular point?
At that point, all the insurance that we do issue to someone is all justifiable, right? So, I'm not just going to come and write somebody a $10 million policy without any justifications behind it, because that'd be over-insuring. But what I can say is every policy that we write, there's strong evidence to show that this is the amount of insurance that person needs.
So, I hear you use the word over-insuring. Is there such thing, over-insurance?
Well, there comes a point where if someone is asking for a lot of insurance, we're going to want to know why do they require all this insurance, right? There could be over-insurance, but we're probably talking huge numbers. Right. If you look at somebody who has, a wife, kids, or a spouse and kids, mortgages are really large now. Even if somebody has insurance for $1 million or $1.5 million, it's not a large amount considering we have education, and the cost of living from month to month, daycare and so forth, right? So it's really hard to overinsure.
So some people ask this question: does the average person really need insurance, or is just something we're being sold?
The average person does need insurance, and that's one of the things, right? It's always good to insure younger, of course, because the rates do favor younger as you're young, and it's hard to think when you're 19 or when you're 21, 25. I don't have any kids. I don't have any dependents. Insurance is not for me.
Right.
But you have to sort of project where you're going to be, years down the road.
Right. So we're saying if I'm 19, 20 years old, I don't have any kids at all, I still probably should get insurance if my life is set in building a family 5, 15 years or 2, 3 years from now on.
Of course. And because another thing too is not everybody could qualify for insurance because there is underwriting. We do look at your health records or your health background. So it is important to always, if you want preferable rates, to get insurance while you're young and healthy.
Right, makes sense. And what are some of those insurance products that you deal with your clients, or that we can actually use to protect ourselves or to secure our liabilities in case something does happen?
Yeah, we do have a whole life policy. And there are, a term product as well that we can look at. And every situation is different, and we apply the certain products to certain situations.
Right, excellent. So there's a term product, and there's whole life product. That's mainly the dynamics of insurance, and then there's a breakdown of what each term or whole life product can actually give you.
Yes, exactly. It all depends on, one of the things is for term, you have a 5, 10, 15, 20-year term or a 1-year renewable term, and it all depends on, again, the situation, what we're what the liability is.
Right. So as preparing for the show, I'm talking to different people who have different situation. And one of the common things, of course, I'm a real estate mentor, and I deal with a lot of investors who own investment property. And the big question we asking, how do we use life insurance to protect our assets? In the sense that most of my investors, they buy properties every single year. So they're constantly expanding the real estate portfolio. Now, we buying these properties in the sense of 5, 10, 15, 20% down. You're still looking at a 75% potential mortgage there, which is a liability debt. Now, God forbid something happens, we want to make sure that those assets, those assets that we put together, doesn't fall to the wayside. How do we protect ourselves?
Well, again, this is an option where one of the best options would be to take out an insurance policy, and we can just, if something were to happen, what will happen is the creditors that have lent you out those mortgages, if someone passes away, they're still going to require the money that's owed to them.
Right.
And with an insurance policy, what we can do is you'd be able to settle the estate, right, and satisfy the creditors.
Right. Okay. Excellent. So, so here's an example. So we're talking $1 million property, 25% down. That's $250,000. You have a $750,000 mortgage still own that property. Would a whole life policy be the smart thing to do there, or a term life? Because of course, over the next 28 to 25 years, that mortgage is going to be paid down. So should we get a whole life policy or a term life policy at that particular time?
Yeah, I mean, I can look at that in two different ways. Okay, so if you just have a mortgage or principal mortgage, you're on your principal property. I mean, yeah, a term policy for the length of the mortgage would definitely be a good way to protect that mortgage. Now, when you talked about the other friends that you have who are long investors in real estate, right, we can look at a whole life policy as a long-term strategy, because if they're going to be constantly buying and selling properties, if you have that whole life policy there, it can be there for 20, 30 years on a fixed cost for the insurance without having to worry about reinsuring every time you get a new mortgage or sell a property. Right.
So as they continue to expand their portfolio, let's say they're buying, every year they decide to buy $500,000 more of real estate. So they're not selling the existing property, just keep adding on. Wouldn't a whole life policy kind of be too expensive in that sense, or no?
Yeah, I mean, I was in the scenario that I was talking about. It was someone who was just constantly buying and selling. Okay. Now, if they're constantly adding more and more and more properties, again, the term, a whole life, depending on their income, may be too costly for their situation. But there's some people who all they want is whole life insurance, right? Because whole life again has value, whereas the term insurance policy doesn't.
Right, it's just a coverage.
Yes.
So again, folks, if you own investment property or you have assets, probably including your personal home, the strategy is to buy term life insurance to cover the life of the mortgage. And as you continue to buy more and more more properties, just continue to buy more and more insurance to cover your liabilities, just in case something does happen, your property will be protected. Now, if people want to get more information about yourself and the service that you offer, how do they get a hold of you, Russell?
Definitely give me a call at 416-464-4402, and that is my direct number, and I'll be happy to help you and give you more information.
Excellent. Now, what's a renewable term?
Like if we look at before I was saying a 1-year renewable term, it's a term that will renew every year, okay? A 10-year term would renew, the price would change every 10 years.
Right.
Okay, so it's not fixed, it changes. So a renewable term changes every year.
Okay, so if I have a term 20, with a renewable term for it, every 20 years it'll change.
It will change.
If I have a 1-year term with a renewable strategy attached to it, every year the price change.
Yeah, the price will change every year.
So in what situation would a person use the renewable term? Where would that become important?
Well, let's just say my intention, we'll make it a simple one. I took out a 10-year mortgage, and I intended on paying off my mortgage in 10 years. And unfortunately, something happens where I need to maybe do a refinance.
Right.
So I need that insurance longer than 10 years.
Right.
With a renewable term, after the 10 years, I'm eligible to keep that insurance for another 10 years without having to submit new medical evidence.
Right. That's very important. I'm glad you actually mentioned that. When a person does refinance on their property, either personal or investment property, they actually want to go back and extend that insurance to cover more debt if it goes beyond what the original policy was, right?
Yes, of course.
Yeah, that's very important to know. And then we have universal life. So explain the universal life policy to me.
Universal life, again, what that's going to do is it also has an investment portion in that policy. So we have cost of insurance and then additional investment portion.
Right.
And what you get to do is you get to choose the type of investments that you would like to your cash values to be invested in.
So I'm getting life insurance coverage. At the same time, a portion of my monthly commitment is going towards an investment. And those investments are going towards mutual funds, stocks, what are they going in?
Yeah, we can do, a daily interest savings account, mutual funds, savings bonds, and so forth.
So I have options. I can be a conservative investor, or I can be an aggressive investor who goes something a bit more aggressive.
Yes. You can go high equity, or you can just go, with a balanced portfolio.
Right. And what's the difference between a universal life and a variable life?
A variable
life. Is there such thing called a variable life?
A variable life. But you mean like a
policy
where there's two lives in there?
Right.
Yeah. So it's like a joint first to die,
right, or
a joint last to die. Yeah. We also have that.
Right.
We have policies where you can insure multiple people on there. So I mean, what's going to end up happening is if you want to insure 2, 3, 4 lives, each person would be underwritten, and it would be either a first or last to die policy.
Okay, and then there's a whole life. A lot of lives.
Yeah.
I guess when we talk about life insurance here, folks. Again, you're watching the Smart Money program. I'm here with Russell Fraser from Sun Life Financials, and we talk about using life insurance to cover your hard work, your assets, and your wealth. So the whole life, how would the whole life policy be different than a universal life?
Okay. The whole life, let's just talk about, so you want to talk about the whole life and the universal.
Right.
So for the whole life policy, just a normal whole life policy, basic insurance, we take the amount you take the premium, and there would be a guaranteed cash value schedule that you would see when the policy is issued to you. The universal life policy, again, you cover the cost of insurance, and then the cash values are up to you to invest.
Okay. So the universal life is optional to invest the cash value, but with a whole life, the cash value automatically goes into an investment that I have options to choose.
Well, with the basic insurance, the cash value portion is invested by the insurance company, and we then issue you guaranteed cash values throughout the life of the policy.
With the whole life?
With the whole life basic insurance.
Right.
The universal life is a whole life policy as well, but the cash value portion is invested, it uses your investment choices to grow.
So, okay, excellent. So you says guarantee. Okay, so again, let's go back there a second. So universal life, the insurance company invests for me? Or I choose my own investments.
For what, the universal life?
Yes.
You choose your own investments for the universal.
Universal life, I choose my investment. The whole life,
you're taking more risk as well.
I'm taking more risk, right? The whole life, the insurance company does the investment for me, and give me a guaranteed return.
Yeah.
What does that guaranteed return look like, roughly?
Well, the guaranteed return, let's just say it's a guaranteed cash value, not return. Right. And what it is a cash value is you have your death benefit value, and then you'll also have a living benefit value, which is the cash value. Okay, right. So 20 years from now, the policy can be worth this much money if you were to cash it in.
Right.
But if you cash the policy in now, then you no longer have access to that death benefit value, so that you're pretty much surrendering the policy.
Okay, excellent. Now, in what case or what scenario would a person need a whole life policy?
Okay, I mean, I personally feel that it's always important to have a whole life policy, and it doesn't have to be one or the other. I've done many combos where I issue some term and we issue some whole life policy.
Right.
Right. So the whole life policy will always be there for them as they get older. One thing to keep in mind with term insurance, the insurance you lose the insurance between the ages of 70 to 80, right? So for instance, a policy that I do, it's at 80 years old, you lose the coverage. Okay? Whole life policy, it's for your whole life.
Right.
And that's why it's called a whole life insurance policy.
So forever. And do you think a person actually does need whole life insurance for the rest of their life?
Of course. I mean, you're going to have cases. I mean, there's not that many assets that the government, you know, when you pass away, the government's not going to tax you on. Okay. Now you have your principal property is there's going to be no taxes on that. But with, as you were saying, with your friends there, with the multiple properties, I mean, they can only have no tax on one. The other ones will be taxed, okay? So, you know, your estate is gonna have a tax bill. So it's gonna, if your estate's gonna have a tax problem, the whole life insurance policy is definitely gonna be there, you know, if they pass away at 85, 105, and that's what's gonna pay down the tax problem from our friends at the...
Excellent. All right, folks, again, we're watching the Smart Money program. My name is Frank Corbin, I'm your host. I'm here with Russell Fraser. He's a financial advisor with Sun Life. We're going to be right back in a few minutes to discuss some of the bad things that you guys are doing when it comes to life insurance. See you soon. All right, welcome back, folks. This is Smart Money program. I'm your host, Frank Corbin. I'm here with Russell Fraser from Sun Life Financial, a financial advisor, and we're discussing how you can use life insurance to protect your hard work, protect your assets, and protect your wealth. So, Russell, the big question is, today, we've seen a lot of people are going online to buy life insurance, to buy car insurance, and just to buy insurance in general, home insurance. What's the benefits and what's the advantage and the disadvantage of going through that process versus dealing with a professional like yourself?
Well, I mean, a lot of people, yeah, they're taking an option of doing the auto insurance online, and I must admit, I did do that the other day. I was looking at some rates, but when I got to the end of the whole quotation process, it did tell me, give me the number of the person to call. And one of the things is, I mean, there was still some other questions that I had in addition to that, and you know, it's always important to get professional advice. Right. I mean, that's where I see things. As far as life insurance, I know a lot of people are going online to get a lot of information, you know, to help themselves make a good decision, so they know what they want when they go to whoever they go to. One of the things, one of the benefits of coming to an advisor like myself is I help my clients make an informed decision. Okay, I mean, I don't expect the client to know everything, but I come there to you know, give them the knowledge, and after looking at their situation and determining how much insurance they need, they do have the ability to make that informed decision.
I personally believe that insurance policy, even though it might seem simple, have so much dynamics to it that the average person really don't understand enough to go and buy it online. So I'm totally against buying certain things online. It's just like life insurance, because we talk about our assets, we talk about our wealth, we talk about the stuff we have worked hard and put together. And you can either protect it by dealing with a financial advisor, or throw it away by just clicking of a button. So you choose where you decide to how you decide to acquire your life insurance. I personally think you should contact Russell or any other financial advisor you feel comfortable with working to get the good information, the good education when it comes to purchasing your personal life insurance. The other question is, what's the tax benefits of having a whole life policy?
Again, like the tax benefits, it's one of the limited assets out there that you know, when you leave it directly to your beneficiary, there's no taxes, so they don't have to pay taxes on that. So I mean, that's definitely a huge tax advantage when it comes to leaving money to other people. So if you leave $1 million policy in place, you passed away, there's no tax paid on the $1 million received. Of course.
Now, I was going to come back to the investment perspective. So as an investor, if a person controls 5, 10, 50 million worth of real estate, when they do pass on, there's a tax, the tax gets hit on their estate.
Yes.
How do we protect that using life insurance?
Well, we would write a nice insurance policy that will be there, like a whole life policy that will be there for you after the ages of 80 and when you pass away, and that will provide your estate the money to pay the taxes and you know, to cover the taxes for the government. Excellent.
So again, folks, you can use life insurance to protect your estate from paying taxes if you decide to pass on, to protect your asset, protect your wealth, and keep your money safe. And another thing I'm seeing, which is big, there's more successful people or millionaires are buying life insurance, and the average person is running away from it. They think it's a bad thing, it's not good, they're being oversold. And here you come the guys like Warren Buffett, or successful multimillionaires, they're using life insurance to protect their asset. What's your take on that?
Well, it's all about the guarantees. Okay, I mean, there's not that many things out there that's going to say, well, you know, we're going to guarantee that you're going to get $2 million, $3 million in 40 years when you pass away, right? And that's a lot of it. As far as you know, passing it down to the next generation, again, it has a lot of tax advantages for that. You're not going to lose a huge chunk of it to the government,
or anybody that's wants creditors who want a part of your pie. So it's very interesting to see a lot of millionaires, successful people, they buy life insurance to protect the asset. And the other thing now, with a whole life policy, which is pretty much the one I'm focused on right now, the whole life policy, you can pay it out within a short time frame.
Yes.
How does someone do that?
Okay, so there's a couple of options as far as paying out the insurance. Now, a general basic whole life insurance policy, you'd pay up until age 100. Okay, so if you're 50, then you're paying for 50 years. With our limited pay policy, we give you the option of paying it up in 10, 15, or 20 years. Okay, and after that, there's going to be no more payments required, but the insurance will continue to cover you for the rest of your life.
Okay, so let's do this. So let's look at a $500,000 policy. Let's assume I want to pay it off within 10 years. Okay, do I pay $500,000 in 10 years, or what percentage do I pay of the $500,000 over that 10 years time frame?
It would be depending on the age. You know, the younger, the smaller the percentage. Okay, so I mean, it's you know, as you get closer and closer to, you know, as you get older, the cost does change just because of the whole mortality thing. But you know, the younger you are, it's definitely you definitely see the huge gap in pricing.
So I was talking to some other financial advisor, and he gave me a rough ballpark. He says, Frank, if you look at the $500,000 policy, it probably costs you anything between $60,000 to $80,000 over that 5, 10, 15, 20 years time frame. So I'm saying, wow, I'm paying you $60,000, $80,000, and you guarantee me $500,000. That's the policy. He said, yes, that's how it is.
Yeah. I
said, wow. So how come the average person don't know this? Because this is very important. If you're looking at a guarantee protection, whole life is the way to go. Okay, and then you're not paying the whole $500,000 worth to the insurance company. It's a percentage for the coverage. That's amazing. Another guy told me, he said, Frank, it's always better to invest in a life insurance policy when you're young. I said, why is that? He said, because when you buy a life insurance policy at age 20, you have a 1 in 1,000 chance of dying. That makes you paying maybe $1,000 a year in premiums. Those are just rough numbers. And he said, if you buy the same life insurance coverage at age 85, now you have 100 in 1,000 chance of dying, so you can pay $100,000 a year for the same level of coverage. So it's always important to get life insurance when you're very young to protect your assets. Even if you don't have assets as yet, and you plan on buying assets, you might want to use life insurance to secure the age. Like Russell talking about the age. Buying it when you're young is always cheaper to protect your assets. Can we use life insurance and leave a charitable organization as a beneficiary? Some people say, Frank, I don't have any kids, but I go to church every week. Or I'm into some young kids development program, which is a non-for-profit organization. Can we use life insurance and leave the beneficiary as a charitable organization?
Yeah, and that is an option to do as well. And you know, when your estate has a tax problem, one of the things you can do is you can donate to charity to help offset the taxes that are owed. And yeah, some people they write policies and they donate to charity, right? As a gift.
So we can protect if you don't have assets in the sense of real estate investment, you don't have any kids as a liability or spouse as a liability in case you passed on, you can use a life insurance policy to keep your particular or your favorite charitable organization going by just buying a policy and put them as a beneficiary. I thought it was a wonderful concept. I think even guys like Warren Buffett, some of these guys talk about that stuff, right?
Yeah, and that limits how much money you're giving to the government in the end, because they'll have to credit what you've given to charity and then balance that off of what they'll expect to get from you.
Excellent. So let's talk about this now. How do we, for business owners, okay, how should a business owner structure his life insurance policy, which would be different from an employee? How do you structure life insurance policy?
Well, there's going to be a couple things to look at. There's going to be some business loans. You'd want to be able to cover the business loans that you'll be taking out if something were to happen to you. Another thing too is we have if you have a key person, key employee, if them passing away would be really bad for business over a long period of time. You may want to insure that employee as a key person, and if they do pass away, it will give you some a death benefit amount to to brace for that loss, as well as the ability to go out and take that money and hire another person to take that person's place, that key employee.
Yeah, and the whole life policies is the only product in the world that has a 100% guarantee. Is that true?
Well, I mean, as far as it paying out, there's a guarantee there.
Right. Kind of what do you say to the people that says, Frank, I don't believe in life insurance? What do you say to that individual?
Well, I mean, it's good to have that discussion. Some people just they just can't get over that hurdle, and you can't be a converter of all. Right. You can only work with people who want to work with you and are going to come in with an open mind. Yeah, there's been a lot of people I've seen who did have that belief, and you can't make believers out of everyone. And I have been able to turn some, but some there's no. You can't win them all, as the saying goes. And
there's a particular subject that people really hate talking about, and that's a sickness in the family, in the sense of inherited sickness and things that pass on from one generation to the next. And how do you, for instance, some families have heart disease. Everybody in the family is going to die from heart disease or have a history of diabetes in the family. How do you protect the young ones with a life insurance policy, in the sense that I get to understand that now, if the insurance company is actually going back on your parents' medical history to see where they stand medically, and if you have a history of certain disease, they can actually deny you, or actually have a high premium in life insurance. So how do you protect the kids in that situation, Russell?
Well, every case will be different, and I don't think that someone should be just automatically just count themselves out.
Right.
One of the good things is we underwrite up front. Okay, so we're able to, we before we issue a policy, as you know, we check your medical background, and we're able to give you a solid offer that will not be pulled back years down the road if you were to become ill from that illness that your parents had.
Right.
But we issued the policy knowing that your parents had that history.
Right.
We're not going to come back and say, well, you know what, we were misled. Right. It's good to insure early if you do have sickness in the family.
Okay. So would it be a smart thing for me to say, sickness or no sickness, to put an insurance policy on my 5-10-year-old kids?
Yeah, definitely. Because we don't know where they're going to go years down the road. If they want to become if they want a job that's very hazardous, risky job that insurance companies don't like insuring. Right. If they were to get the insurance policy as a child, the insurance company can't go back and say, well, we don't like the job that you are, so we're pulling the insurance away.
Right.
The insurance company will only underwrite going backwards, but they cannot go in the future and change their mind.
Right.
So that's why you'd want to insure.
So we can take a whole life policy. Let's say you have kids 5, 10, 15 years old. You take a whole life policy on them, and I guess they can be the beneficiary, whoever can be the beneficiary. Would that be expensive, or is it based on the parent or based on the child medical situation?
It's going to be based on the child's medical history, but there's always a question where we ask about the parents. We want to know even if you were to fill out an application today, we would ask for your parents as well as your siblings, if they've had any health issues that you know about. Right. So it's always, everything is taken into consideration in that sense. Excellent.
Again, folks, we're here to talk with Russell Fraser from Sun Life Financial, how you can use life insurance to protect your assets, protect your hard work, and protect your wealth. We're talking about term life insurance, whole life insurance, what kind of insurance you need as an individual working a 9-to-5 job, what kind of insurance you need as an investor, more important, a real estate investor, to cover that mortgage, that's the unpaid mortgage. And as a business owner, what kind of insurance you need to cover yourself just in case something does happen. Your outstanding loan or debt that you have on your name doesn't get transferred into your estate. And more important, if you just passed on, there's estate taxes you're going to have to pay using life insurance to cover that. Again, Russell Fraser, how do the folks get a hold of you?
You can contact me direct at 416-464-4402.
Okay. I get to understand also millionaires use life insurance to create liquidity. How does that work?
Now, it depends. Are we talking about in their estate or another in retirement?
Both. Let's say in retirement. How do I create liquidity in a retirement with a life insurance policy?
One of the options that we can look at is, and when you have a couple, and when whoever passes away first, the surviving spouse would then use that life insurance policy, right. The proceeds from the life insurance policy to help fund the retirement, later on in life.
Right. Now, here's the thing. Let's say we have a whole life insurance, and we paid off. What percentage is the cash value going to be, let's say, after 20 years? So let's say a $500,000 policy is paid off within 10 years time frame. What's the cash value going to be in 20 years time? The coverage in reference to the cash value.
Each policy is going to be different.
Right.
Each policy has different characteristics, depending on, like for instance, for the universal life policy, how much that the client has overfunded the policy will also determine how much cash value is in there.
Oh, so we can actually overfund the policy?
You can overfund the universal life policy. But what I have seen with some basic insurance policies is as you get closer to the age of 100, the cash values will also get closer to the death benefit amount.
Really? At age 100?
As you get closer to the age of 100 for, let's say, a basic whole life policy.
Okay. So again, so you buy a $500,000 policy, you pay it off at age 100, the cash value is as close as the death benefit. Can you remove the cash value from there?
Yes, you could take a loan out on the
right. So you can use that as a form of liquidity.
Yes, you can.
Let's say close to $1 million, you have close to $1 million worth of loan. Does that loan need to be paid back?
What will happen is when you pass away, whatever is owing on the policy would be paid first by the death benefit, and then the remainder would then go to
the estate
or the beneficiary.
Yeah. Okay, so there you go, folks. You buy a whole life insurance policy, you pay it off within 10, 15 years, or whatever time you decide to pay it off. Close to age 100, according to Russell, the death benefit and the cash value can be almost close to each other. So if you're not happy with your friends, you're not happy with your spouse, you're not happy with your estate, you take a loan on the policy and you go on vacation. Because it's liquidity now, it's cash, it's almost like an investment, right?
Yeah.
So again, if you take $1 million worth or $800,000 worth, you go on vacation, have a wonderful time. If you do pass on, the insurance company gonna pay back the difference to the policy, and the balance goes to your estate or goes to your family, spouse, who the beneficiary is, right? Excellent, folks. Again, folks, that's our program for today, the Smart Money Program. I'm your host, Frank Corbin. Again, my guest is Russell Fraser from Sun Life Financial. Again, Russell, tell folks how they can get a hold of you.
Again, you can get a hold of me at 416-464-4402. It's my direct line, and I'll be happy to talk about what we've talked about today, specified for your situation.
Excellent. So that's our show for today. We have a lot of more smart money situations coming up, a lot of more smart money topics, from investment to credit to you name it. Anything to do with you investing smart, budgeting smart, and doing what you got to protect your assets, protect your family, and more important, building generational wealth. Because the work you're doing today, your kids shouldn't have to do the same level of work unless you're doing something really wrong. Okay? Thank you guys for your time. Thank you for watching. Again, my name is Frank Corbin from the Smart Money Program. See you next time.